closing just above Gamma Max here, the much smaller intraday range than what was priced in this morning. Obviously, advantage to the option sellers with a 10-point move to the upside, but still one more green day in the bag. Start to move more into SLD tomorrow, Friday. I think upside positioning today wasn't nearly as dramatic as it was yesterday. Definitely not a lot of delta coming into the upside, at least from what I was looking at. So I would expect that moves up in Gamma Max and Vega Neutral are going to be slightly less than they were yesterday. And we're still kind of butting up against pretty hard resistance on the upside here. A pullback and some more substantial repositioning would probably serve the bulls better than continuing to try to leverage up and pump to the upside here. So I do expect possibly some more profit taking and weakening of the delta to the downside that we saw a little bit of yesterday. Probably saw a little bit more of it today. And that may continue into the end of the week, possibly setting us up with a little bit of a bearish bias at the beginning of the week following the OPEC's expiration. Still no quarterly OPEC, so not super significant, but I mean, some delta will fall off. Yes, the second day I failed to breach 59.27 to the upside, but also failed to fail 5,900 to the downside. We will have to wait for that failure, and a persistent failure of that level probably to get any move further down. But I will say from 5,900 down to about 58.37, there's very little significant support. 58.37 could be as far as we pull back, and if we did pull back there, I would probably be buying that dip, but maybe with a tight stop. But for now, yeah, I mean, it doesn't look like we're quite ready to move down at all. Just a lot of resistance to the upside. Dollar climbed today on some UAE or not UAE trade deals, but Saudi Qatar trade deals that were announced by Trump during his visit there. Yields, however, especially at the top end of the curve and in the belly, all continued to rise pretty dramatically. Remember, the dealer short that we talked about in the prior week on that massive leverage in the 5-year futures. Um, you know, those longs are getting squeezed out, and that's probably why we're seeing a little bit of overperformance in the 5-year relative to the rest of the belly. But some of this also in anticipation of PPI tomorrow. Tomorrow is going to be a huge, definitely the most important day of the week by a long shot. We have, I think, overnight we have 5-year JGB auction, and then we have Chinese M2 supply, and then we go into like German wholesale prices, Great British GDP, EU GDP in the morning, then US PPI, jobless claims, New York and Philadelphia indexes, retail sales control group. Which report is that? Then we have Philadelphia capex and business conditions. No, just retail sales. And then we have Powell right after retail sales speaking at 8:40. Then we have U.S. industrial production, capacity utilization, production, so forth. Business inventories after market open, retail inventories after market open, NHAB housing index, and then I think later in the day we have like one Fed speaker. But tomorrow morning pre-market is wild. After that's all passed, there might be a little bit of vol crush, but that's a lot of events back to back that can all drive volatility higher. So yeah, it's almost all in the pre-market. Friday's got some stuff too. Michigan Consumer Friday will be important, but tomorrow's definitely a big deal. And I suggest at least getting the notes on Powell's speech before market opens, so you're aware of what was said. I imagine he's going to be in line with what was said at the prior FOMC meeting, and what has been, echoed by Fed governors over the last week. I don't think he's going to stray too far off of the narrative. I think the most interesting things tomorrow are actually going to be British and Euro GDP, and then probably PPI. A little bit manufacturing and capacity utilization, like production capacity utilization. If those miss the mark, it could stir up some more recessionary fears, but I think PPI is going to be the biggest focus. Fuchs will tell us what he said. You're not wrong. Well, sort of. Commodities down today. Drops. Oil finally dropped off a little bit, but still above 62 a barrel. Gold falling below the 3,200 mark. Silver following suit. Copper also down. A little bit of bump in agricultural and materials, though. Correlation started to turn around a little bit in the end of the day on the 1 and the 3 month. Correlation now lower than it was prior to the tariff implementation. But we could see a little bit of a snapback in that as some dispersion lets off steam into the end of the week and dealers start shedding some of that delta. Especially if IV falls on single equities. Forward yield on volatility way down, 5.67%, nearing its low, like recent low, but leverage in the carry up again from 8.7 to 8.8 today. Bond volatility at 100. Correlation on the 3 months still dropping. We're probably gonna see bond volatility continue to move down. Still no out of the money put demand. Skew's still picking up as of yesterday. This is interesting. Correlation between VX and cash fix rose. Today's the expiration, tomorrow's expiration. So you got a bump in correlation there, back to 97.26%. Still very sensitive. So a little bit interesting that volatility is moving back up again. I did mention a couple days ago that because that correlation's remaining high, volatility is still going to be very sensitive. So we could get another rebound in volatility should short vol decide to reposition here. And this is a very good place for them to do that. Breadth didn't really pick up much yesterday. Actually, lost some ground with only 75% of the S&P above its 20-day moving average. I would imagine the same out of today, with Dow and Russell still underperforming, and most of the positive side of things being carried by NQ. Fed fund futures now pricing in less than 15 points of rate cuts into the September meeting. And the bear steepener picking up moderately, but not enough to cause any concern. But yeah, I mean, S&P today really underperforming in almost every sector outside of like the Mag 7 and a couple other select tech stocks. There's a couple winners in finance, but majority down. Retail trade, health tech, producer manufacturing, all kind of shitting the bed. So mostly just Mag 7 kind of carrying everything here. And then out here on the technical side of things, today marks the second day that we have not crossed that upside trend, but still have not sufficiently lost any room to the down, lost any ground to the downside. We did slip the, I think that's like the March low or some shit. I forget which. Feb low? That might be the Feb low. I don't know why. Oh, no, this was the October high, 58.78. Falling back below 58.37, which is in fact the February and kind of December low, is the major level to the downside that would, trigger that would at least signal a reversal. Losing 57.73 would confirm it. I would expect that support would be found somewhere in here for a push higher, in this range. Hold on, let me try to highlight it between here and here. But so far we haven't even lost 58.37 yet. So those would be what I'd be looking for to the downside. To the upside, a breakout above the trend would be probably a fairly good signal. There's scale weird, that's why it shows a wick above it on the monthly. But that 200 MA still very important, especially if we don't hold above it. And then out to the upside from here, I guess like 59.47, maybe 60.31. I would say there's something in here with like the March high around 6,000 that's probably important. But first things first is that trend. I'd like to see that broken to the upside as a signal for, a further move up. Right now, and so far, over the course of this entire move up, if we go out here and we look at the Greeks over on SPX, things don't look very bullish. Right, total adjusted delta has stayed negative this entire time on the monthly chain. We did get a bump in gamma as over the last 2 days, but that's been kind of bleeding off. We're not really picking up more gamma. We're running into Vega neutral, which is kind of a hard resistance anyway. But the uptick, like the upswing in like delta and gamma neutral, indicate that there's probably at least a fair amount of out of the money profit taking. Now, remember, this is last night's closed data. I know we only moved 10 points today, so it's still relevant. But the fact that VN is moving higher, and then GN, DN are following suit, means that we're probably seeing a lot of the puts that were sold on the initial bounce down there at delta neutral pull back. And as profit taking occurs on those positions, because they're also short dated, we're probably going to see gamma neutral kind of move even closer to spot. I would imagine it moved up again today. With gamma neutral not so far out of the money, the ability for the market to fall back into that higher volatility environment is going to get more pronounced. And with less supportive delta on the chain, those charm flows aren't going to help as much as we move towards larger expiries like this OPEX. And so I would keep an eye on that. This doesn't look quite as stable as it should, or as bullish as it should. On the weekly chain, things are still pretty supportive and slightly bullish, and gamma max is rising, but DN and GN are also pushing up. So we're seeing that same effect on both chains, and with the lack of interest on the monthly chain, that means a lot of the positioning isn't very durable. GMW needs to keep moving up to make those higher levels possible. Yeah, I mean, ideally. But if it moves too far away from spot, that's actually bearish. So if GM is moving up with spot simultaneously, that's really bullish at spot. But if like spot pulls back and GM keeps going up, that's not good. That starts to mean that the concentration of gamma is shifting towards like out of the money sold calls and not at the money calls. Do you have any thoughts on PPI? I think it has a much better chance of missing analyst estimates than CPI did. Like I was pretty just I didn't think anything was going to come of CPI really, and CPI really was kind of inconsequential. But there's too many moving targets to really pin down where CPI is going to be. There was a big inventory load going into the tariff announcement, and that's going to act as somewhat of a shock absorber for demand. But there's consistent demand always occurring, even with the inventory, like the pre-bloating in the inventories. And so while most responsible businesses probably did try to pick up what they could prior to the tariff implementation, not all of them necessarily did. And then there's also constraints on how much raw materials you can hold at any given time, or and so there's always a persistent demand, and how much that persistent demand has inflated and how much demand is there, we don't really know. I mean, you'd have to build a very very complex model to kind of try to pin all of that down. But I do think that analyst estimates for it are a bit light, and so there's a slightly better chance that it could miss. I mean, that's all you really care about with the CPI PPI prints, is that analysts miss a little bit. And you can see from the bond market already that they're kind of leaning more towards higher PPI. That's one of the reasons we're seeing like yields climb up going into tomorrow at such a dramatic pace, because I think they are anticipating that PPI will be a little bit hot. I don't care anymore. You can get rid of me. Why? 20 you're above 5. Yep. 30 you're very close to 5 too. And the 10 you're at 5.4 or 4.5. 4.5, almost 4.55. That's also gonna put pressure on things, and the closer we get to 5% on the 10-year, the more likely it is going to become that the Treasury has to take some kind of action to bring those yields down, and that's, you know, if the Treasury or the government take any kind of action to bring yields down, that action's probably going to be bullish bonds, bearish equities, especially with how sensitive volatility is right now. Critical leverage, around, it depends on the bank. It varies. And there's still like zero point 0.9 trillion in losses that can be realized between like 4.5 and 5, but it really gets bad above like 5.5, 5.25 to 5.5. That's where you get about three point, I think it was like 3.47 trillion in losses. Then above's like 5.5 out to 6%, you get another like 8 trillion in losses. Well, losses that would have to be realized in order to maintain liquidity, basically. So it gets very very dangerous to the banks out there. We got 16 billion tariffs coming in. No, we don't. That's not how they work. Anyway, thank you all so much for tuning in. I will see you guys tomorrow morning. Have a good night. Later.